Want to learn how to recognize key market reversals? Today we will discuss three powerful Japanese candlestick patterns: hammer, doji, and engulfing. These bad boys will help you predict the price changes and make reasonable trading decisions. Stay tuned to learn how to make your trades accurate and profitable. Hello everyone, my name is Victoria. I'm a professional trader with more than 5 years of experience in the financial markets. I'm glad to welcome you to my channel. Here we make trading accessible and understandable for everyone, even beginners. Today we will learn about Japanese candlesticks and how they can help you recognize reversal signals and make decisions based on market changes. We will take a closer look at powerful reversal indicators: hammer, doji, and engulfing patterns. Watch closely, listen sharply, and let's get down to business. First of all, Japanese candlesticks are one of the most popular and powerful technical analysis tools, allowing traders to quickly and effectively analyze price movements. Candlesticks display information about the maximum, minimum, open, and closing price for a certain period of time. This data can be used to identify patterns that indicate possible trend reversals. The hammer pattern. The first pattern we will learn today is the hammer. This pattern occurs at the end of a downtrend and signals a possible reversal. The hammer is characterized by a long lower shadow and a short body, which signals to us that sellers try to push the price down, but buyers pushed it back to the opening level. When we see a hammer on the chart, it can be a strong signal to buy, especially if it's confirmed by volume or other indicators such as RSI or MACD. The next pattern is the doji. Doji is formed when opening and closing prices are at the same level or very close to each other. This shows us the certainty of the market. Buyers and sellers cannot come to a consensus. The doji pattern may signal both a reversal and a continuation of a trend, depending on the market context. If the doji appears after a strong trend, it may be a signal that the trend is ending and a reversal is expected. However, it is very important to always use additional indicators for confirmation. Engulfing pattern. The third pattern I will talk about is the engulfing. This pattern is formed when one candle completely engulfs the previous one. It can be either bullish or bearish, depending on which way the market is headed. A bullish engulfing indicates a reversal upward, while a bearish engulfing indicates a downward reversal. To trade the engulfing pattern, it is important to monitor the volume. If the volume increases when the pattern is forming, this reinforces its significance. Now let's look at the advantages and disadvantages of Japanese candlesticks. The main advantage of Japanese candlesticks is their visual simplicity and ability to instantly convey information about the market mood. With the help of these patterns, you can effectively find entry and exit points, which is especially important for binary options, where the timing of the deal is the key. But do not forget that candlesticks pattern require confirmation by other indicators. Using only one pattern without the context can lead to false signals. Let's look at an example of trading using Japanese candlesticks. Let's say you see a hammer pattern on the chart after a downtrend. This could be a signal to open a long position. However, to increase the accuracy of your forecast, you can additionally check indicators such as RSI or MACD. Similarly, if a bearish engulfing pattern forms at the top of an uptrend, this could be a sign that it is reasonable to consider a short position. By the way, in my Telegram channel you can find daily deals using which you can start earning yourself. Join so you don't miss new deal reviews. So, let's try applying the three patterns. Today we looked into the hammer pattern, doji pattern, and bullish and bearish engulfing. I have already prepared currency pairs with a payout of more than 70%. Let's start with $100. We will probably increase this amount later on, depending on the market. Guys, pay attention to this point right here, because here we have the Doji pattern. Here we have a high probability of a reversal. So let's open a sell deal for $100 and 2 minutes. Currency pair money real, Chinese yuan. Excellent. We have a positive deal that brings us profit. So let me remind you once again, we had a Dodgey pattern, and here a reversal occurred after several candles. Wonderful, let's move on. Well, here we have pretty much similar situation. We see the Dodgey pattern, after which more often than not a reversal occurs. Here's a very clear reversal. If you look at this whole story like this, let's see how this deal plays out. We got ourselves a negative deal. This would be the perfect time to remind you that to confirm a pattern, it is absolutely necessary to look into different indicators, such as RSI or MACD. Right, let's open the RSI and increase the deal amount. The next currency pair is Euro Turkish Lira. Again, we have a Dodgey pattern, but I now open a buy deal. So let's see what the results will be. Excellent, the deal went positive. Today we got 2 positive deals and 1 negative, and as a result we earned about $250. So, Japanese candlesticks are a powerful tool that helps traders better understand price action and find reversal points. Patterns such as hammer, doji, and engulfing can become an important part of your trading strategy. Do not forget to combine them with other indicators to increase the accuracy of signals. If you like this video, subscribe to the channel and click the bell to stay up to date with new videos. Like this video and I'll see you in the next one. Bye!